All right, welcome back to Nadlin Forum Podcast Daily. I'm Ruby, joined by Leor as always. And today, look, I'm still scratching my head about this, honestly. Mortgage rates went up even though the Fed just cut their rate. Like, did I dream that headline or did the universe just flip upside down? Leor, we literally just talked about the Fed's big move. I was all set to refi my place, locked in on the news. Then the mortgage guy calls and says, sorry, rates actually went up. I'm sorry, what? Weren't we supposed to celebrate?
Yeah, I saw it too. So let's just break it down for a second. The Fed made the very expected cut, 0.25%, from 4.25% down to 4%. Stocks, they loved it. There was this huge surge, all the major indices, record highs. But for mortgages, which really depend on those long-term bonds, it's the opposite story. I mean, the 10-year Treasury yield, that's like the canary down the mine for mortgage rates. It actually shot up, hit 4.145% after dipping below 4% earlier.
And the 30-year too, right? I think I saw it climb to nearly 4.8%. My bank was quoting me higher rates than a week ago. I just don't get how a move designed to make borrowing easier is making my life harder.
You're actually right. And I gotta say, this isn't the first time. Investors were betting on lower long-term rates. But what happened is almost textbook. The Fed tries to boost the economy. Traders in the bond world go, nah, we're worried about inflation. And they start dumping long bonds, pushing those yields up. So the very thing that was supposed to help borrowers like you kind of does the opposite.
It just feels backwards. Like, if there's a shortcut to affordable loans, somebody in the bond market keeps rerouting the GPS. I think we even touched on this in that episode where mortgage rates shot up after a supposed good Fed move. It just keeps happening.
Yeah, so the question is what's going on in their heads, right? The bond traders basically freaked out after the Fed cut. It's this fear. Is the Fed getting soft on inflation? The market starts to think if the central bank's not as focused on fighting inflation, that could mean prices stay high. So what do? Sell the long-term bonds, drive prices down, and then boom, yields go up.
You know, Peter Bookvar, you probably saw his quote. He basically said bond traders were selling the news as soon as the Fed announced the cut, like almost an okay, we've made our money, time to run for the exits moment. But what gets me is they're reacting to what they think the Fed might do next, instead of what's actually happening right now. It's all vibes and second guessing.
Totally. It's tricky. Actually, this really reminds me a bit of a tangent. But back in Israel during the 2008 crash, we saw something similar. Central bank tried to calm the markets, but the bond guys worried they'd let inflation run. So you'd get this weird split where stocks rise on hope and bonds sag on worry. In the US, same story. The Fed's trying to walk a tightrope, but bond traders don't forgive easily when it comes to inflation.
No forgiveness. Yep. It's like if markets get even a whiff of maybe they're not taking inflation seriously, people panic sell their bonds just to get ahead. And those worries are global now, right? I mean, bond yields have been rising in other countries at the same time. This isn't an isolated Fed blunder. It's like a ripple hitting everyone's shores.
Right. You get, for example, Europe still battling higher than usual inflation and their bond yields go up too. It's almost like a global domino effect. So to tie it back, mortgage rates in the US are kind of hostage to these wider trends. Even if things look stable here, if global investors start pulling out of bonds, mortgage rates just don't budge down.
Let's bring this home, literally. So if you're looking to buy right now or refinance like me, these higher mortgage rates hit you smack in the wallet. We've got home builders like Lena reporting weaker sales because buyers just can't handle these payments. And frankly, affordability was already rough before this little rate roller coaster started.
Absolutely. Lennar's CEO even said they're seeing pressure from the ongoing high rates. And for buyers, it's this double whammy. Home prices are still high and now loans cost more. As we saw last episode, sometimes buyers get lucky with timing. But if bond yields keep rising, these mortgage rates might stay high or creep even higher.
So, do you think people should act fast? If I wait for a dip, maybe I miss out? Is this one of those act now or pay later things?
It's impossible to time this perfectly. Based on what we're seeing, bond market jitters, global uncertainty, inflation sticking around, if you find a rate that works, it might be smarter to grab it now. But, like we said in our housing market slowdown episode, patience pays if you got the flexibility. Just don't gamble your main house on some magical coming drop.
Even if the Fed keeps trimming rates, those global bond ripples might keep mortgage rates sticky. Honestly, my takeaway is know your limits, do what fits your budget, and maybe don't wait for the stars to align or for the bond traders to do you a favor.
Couldn't say it better. The real answer? Stay nimble. Keep a close eye on those yields and don't sweat trying to outguess the whole market. It's a marathon, not a sprint, as we keep saying every week.
All right, I'm calling my broker after we finish this. Thanks everyone for listening. Whether you're rate watching or just mortgage curious, we'll keep tracking these twists for you. Lior, always great to chat.
Same here, Ruby. We'll be back tomorrow, everyone. So stay tuned and stay savvy. Bye, Ruby. Bye all.
Cheers. See you next time on Nadlin Forum Podcast Daily.